So thanks everybody for coming. We sure appreciate it. Tyson and I have really tried to get a feel for what's happening with the real estate and the interest rate market based on two things, right? We have these bank closures that happen, which were pretty dramatic. And it's more in the sense of what does this mean? Is it the beginning of a domino? And then it actually caused kind of a pivot with the feds with the timing of when that happened. And so those two things combined, we thought were really important to get a feel for the market and what it might be doing to impact us. So nice to see everybody that's joining us right now. Thanks so much. Tyson, I'm going to go ahead and let you take it, and I will try to watch the chat bar. And then you guys just let me know, put any questions in the chat bar or unmute yourself. We're not going to have a huge group. We had a bunch of people say they just need the recording. So let us know if you have questions as we go along.
Hey, perfect. So today we'll mainly just focus on kind of what's the deal with the bank failures. I'm sure it's been all over the news, so it's been hard to miss. And then the Federal Reserve also met this week, so we'll talk about what happened there. So as an outline, we'll look at what I just said, and then kind of what those two things impacted, how they impacted interest rates and where we think they're going from there. And then Bliss will talk a little bit about some market conditions and kind of questions that you might get. And then of course, we should have some time for questions.
Yeah, and hopefully you can stay to the end because I actually want to talk about a new phrase that's kind of being batted around the industry, and it's called, wait, where's my note here? Oh, house hostage or mortgage hostage, right? So we're going to get into that a little bit depth kind of at the end once Tyson's done.
Hey, awesome. So what happened at the Fed funds with the Fed funds rate at the meeting? So they raised it another 25 basis points, which is what they did last time, but also it's down from the previous rate hikes. So now the target rate is between 4.75 and 5%. That's the 9th consecutive increase in the past year. So that's pretty unprecedented. We saw unprecedented cuts in the COVID years, and then now we're seeing unprecedented increases. So one thing that's interesting is, so the Fed, after their meeting, they do a press release, and then Jerome Powell talks, and then they do a full report release. So there's all these different things that they release to the public. In the past few Fed meetings, they've always had this line, ongoing increases. So that was kind of the rhetoric, like, you know, this is what happened. There will be ongoing increases. This time it's been replaced by this big long thing that's pretty vague, but basically they're going to monitor upcoming information. The committee anticipates that some additional policy may be appropriate. So it's backing off a little bit from that hard line. Yes, there will probably be increases going forward, to now we're going to monitor things and see how they go. So that's interesting. But then also you look at this chart. So I've actually never showed this before, but it's super interesting. So each dot on this represents a committee member. And so this is basically a survey of the committee, of the Federal Reserve Committee, and where they think things will be headed. So I know this looks kind of chaotic, but the blue dots are what they thought December of 2022, and then the purple dots are the updated feelings. So this section right here is 2023. So this is basically where each committee member thinks, and this is not mortgage rates, I have to clear that up. This is the Fed funds rate. So this is where they think it will be at the end of the year. So most of the committee thinks it will be a hair above 5%. And that's almost where we're at now. The target rate is 4.75 to 5%. So that could mean, and that likely means, most of the committee thinks there's going to be at least one more 25 basis point increase. Okay, and then we do have some, you know, one guy thinks it's going to be close to 6, or girl, whoever that committee member represents. So that's the most interesting part of this plot to me. But then we look at 2024 and it's spread out a little bit more, right? We still see kind of a consensus clump here in the low 4% range. And then on anyway, it trends down, which is good news. So even though they've removed some of that more specific language about ongoing increases, it still seems like the majority of the committee thinks there'll be at least one more 25 basis point increase. Now, what's interesting about that is the market isn't necessarily reacting according to that. They're kind of blowing that off and thinking that the Fed is going to be done raising interest rates. That's how the market has reacted. So we did see a pretty big we did see MBS mortgage-backed securities rally yesterday, so that's good for interest rates.
Hey,
And
Tyson.
then, sorry, I think I just muted wherever that noise was coming from. So
Oh, were you able to mute her? Perfect. Thanks, Tyson.
okay. Yeah, so mortgage rates improved yesterday after that Fed announcement, which is a little bit surprising considering there's still likely going to be another interest rate hike at the next Fed meeting. So Bliss, did you have anything else to say about that? No, we're good. Okay. All right. Okay, so this is just kind of where we've been, you know, the rate hikes that have happened historically. So this is what I showed at kind of our predictions meeting back in February. So this is still, I didn't change this at all, but this is now not just a prediction, but has actually happened. This 0.25% rate hike. And then personally, I still think there will be one more. And then towards the end of the year, I don't know. There's a lot of people that think there will be rate cuts by the end of the year. And I left that rate cut, that negative 0.25 on there because I'm a hopeless optimist. But it could stay steady. Personally, I'd be a little bit surprised if we saw more than one more rate hike this year, but things change. A lot of things I thought that were going to happen last year did not happen. So we'll just have to see where it goes. Okay, now let's talk about the bank drama real quick. Here's a quick timeline. I'm just going to kind of blow through this to remind everyone of what happened, or if you haven't followed it very closely. So March 8th, Silvergate Capital, which was a crypto-focused bank, basically folded. They said they're going to cease operations. Silicon Valley Bank made some comments that concerned investors. They said they need to raise some capital, $2 billion. March 9th, they're saying, you know, everyone needs to stay calm. We're actually quite sound, but their stock plummets regardless. And then by the 10th, the very next day, Silicon Valley Bank fails. And the regulators had taken over by midday. So that's the FDIC. And as a result of that, investors start dumping bank stocks, right? And Signature Bank is another big one that starts to see kind of a run on their deposits. But the Treasury Secretary says the banking system is resilient. March 12th, Signature Bank is seized by the regulators, but they're still, you know, putting out all this positive stuff, positive rhetoric that the bank failures, the taxpayers won't have to pay for it. Funds will be available. This isn't a big deal. March 13th, a lot of regional banks see stocks plunge. First Republic was the one that got hit hard, or the biggest. Their stock dropped 60%. Then we start to see international waves, right? Credit Suisse, their shares tumble 24%. And then by the 19th, UBS, which is Switzerland's largest bank, takes over Credit Suisse. And by that point on March 19th, so 11 days from the initial rumblings and banks failing, US banks had borrowed almost $12 million from the emergency fund program.
I think can I add one thing in here?
Yeah.
Because a lot of consumers and as real estate agents, you might be getting questions from your clients saying, what does this mean for me, right? You know, I don't know that at this point it's going to mean a lot to them. Except it did cause rates to come down a little bit. But regional banks, where that could be a problem is if you work with builders that have construction loans, that's usually through regional banks. That's kind of the level where a lot of construction lending is done. And so there is a chance if this, again, everyone's spinning it positive right now. We're fine, we're fine, we're fine. It's not going to be a domino. But if we do see that starting to happen and you work with builders, there's a chance that there could be some effects in that sector. So not directly tied to mortgage rates, but absolutely directly tied to the real estate market. So that's just kind of my opinion on that one piece that might affect you guys if you're working with builders. So
Yeah, no, that's great. And a lot of this stress on the banks comes from these elevated interest rates, right? I mean, that's banks. We often think that consumers borrow and lend money from banks or borrow money from banks, but banks borrow and lend money from each other all the time. So these increased pressures of higher interest rates does put more stress on banks. And so I think that's where there could be potential trouble. And the Federal Reserve is starting to realize that. Like, that's one of these indicators that, okay, maybe we need to back off on the Federal Reserve rate hikes. But anyway, so that's kind of the timeline. And then, as Bliss was saying, how did mortgage-backed securities, what does that mean in the mortgage industry? So when we start to see this, there were initial gains. So you kind of have to think of it backwards. Mortgage-backed securities, when I say gains, that means rates are dropping. And the reason that happens is investors are running to safer assets. When banks fail, they don't want to invest in banks, right? So investors are taking money from that and putting it into safer assets like mortgage-backed securities. But then the concerns, I was surprised, they eased relatively quickly. And we saw some drops in MBS, which means mortgage rates go higher. Now, there were still more gains than losses, so it still kind of helped. I mean, you hate to see banks fail and the panic that causes, but from the mortgage perspective, it did help. And then just in the meeting from yesterday, or the press release from yesterday, Chairman Powell said that the issues were limited to a few banks and that the broader financial system is sound and resilient. So, I mean, what we're hearing from the Federal Reserve, from the Treasury Secretary, from all these positions is that, this was kind of a limited blip. There's no need to panic. So anyway, take that as you will. I know some people won't believe that, but we'll just have to see. Really what matters is what the general public believes and if it induces panic or not. At this point, it looks like kind of the initial concerns have passed, and we'll just have to see how future
one
banks
question, if you, as agents, if you ever have a client that asks you if they that they're really, they say they're really nervous about their money in the banks, so they're going to take their money out and just keep it at home under the mattress, just remember that's not verifiable assets to buy a house. And so do that, if you want to, with a little bit of your money, but if you're going to be buying a house and using money, it needs to be in the bank. So I just thought that might be one of those unintended consequences that consumers that get nervous and pull their money out of a bank might do, and then they want to buy a house, and then we have a problem. So just keep that in mind if you get those questions.
Yeah, perfect. All right. Okay, so with those two things, with the Fed meeting and the banks, little bit of bank drama, where do mortgage rates go from here? So banking concerns probably won't play a big role unless there are more bank failures. I don't see that as having much more of an impact going forward. Yeah, so there's that. Inflation and the other economic, I put dates there, but data will still be the biggest movers. So that's the biggest thing the Feds are still going to keep an eye on is what's inflation doing? What are the job reports doing? What are the new home sales doing? And all those other literally dozens of economic factors that we've mentioned before. Those will be the biggest drivers in what rates do going forward. Having said that, so it's interesting. We've bounced between 6 and 7% for the past, I don't know, it's probably been 5 or 6 months now. And I think that could continue. A little bit of volatility kind of up and down as these different economic indicators come out. Hopefully we'll see a consistent trend downwards by Q3. That's what I'm hoping for. And that's what a lot of people think. Some people think it could happen earlier than that. But again, it's this complex economic machine that, little bits of data and reports come out almost every day, and the market reacts accordingly. So hopefully the hope is that the Fed has increased the Fed rate enough to the point where it will slow down the economy at a healthy level where it's not going to crash, but that they can start to ease down that Fed rate, inflation gets in check, and mortgage rates will follow. That's the hope. Okay, so that's kind of all I had on the data side of it, I guess you could say. Yeah, so Liz will talk about being a mortgage.
That was awesome information, Tyson. I mean, in the end, nobody has a crystal ball.
Yeah,
absolutely nobody. I loved the little dot map. I'd actually never seen that one before. Because what I loved about that is that projections for 2024, 2025, right? We're kind of in a downward projection for interest rates. And that's going to be something to really hold on to for that, in mainly the positive attitude, right? And a lot of what conversations I'm having with clients right now, and I know a lot of you are as well, if someone can afford, because we don't want to do something someone's not comfortable with, even if on paper they qualify. If they're comfortable, and even if it's a little tight, but they're still comfortable, they can buy a house now. They're going to lock in their house price, even though interest rates are high. And then at some point, of course, no guarantee, but at some point, I usually like to say within 12 to 24 months, they're going to be able to do a refinance, get their interest rate down. But I guarantee you at that same point that interest rates come down enough for a refinance to be an option, house prices are going to go up because Utah still has a housing shortage. So now I wanted to talk briefly about this phrase that you may start hearing called, you have to keep having to look at it, housing hostage or mortgage hostage. So what that means is you have someone that either bought a house or refinanced in 2020, 2021, beginning of 2022, and they've got an interest rate that starts with a 2 or a 3. And it's not their forever home. And they're ready now to buy their next home, to step up. Maybe they're in a condo or a townhome, or maybe they need to move because of their job. So it's maybe even a lateral move house price wise, but because of interest rates, that's going to make their payment on the new house so much higher. You even have people that are retiring, they want to downsize, but even downsizing, their payment's going to be higher than it currently is. So I think what we're going to find as an industry is we have a lot of people paralyzed because it's comfortable where they're at, and maybe they're willing to go a little bit higher, but they're not willing to go $1,500, $2,000 higher to move into their next house. And so I think it's important as an industry that we're really sensitive to that, right? And we don't just brush it off of, you know what, that things are just more expensive now. I think it's important that we connect your clients with a lender. Obviously, we hope it's us, but really any good lender is going to take them and kind of hold their hand and walk them through looking at all of their options. I've got a couple right now that bought in Daybreak 2020. They're at 2.99%. They really want to live in Park City. In their situation, their payment is $1,900. They can rent their Daybreak townhome for $3,500. Park City, they're going to buy something between $800,000 and $1 million. Luckily, they do have some down payment. They don't need to use the equity from that house. But that rent increase is going to offset some of the increase in their house payment. But they asked me to show them numbers between $800,000 and $1.2 million. And I think that's good. Let's look at this range. Maybe your next home isn't quite as much as you want, whether that be square footage or maybe the basement isn't finished, some things like that. But really providing our clients with as much data and information as possible so that when they do make that commitment to buy or sell, they're going to feel really confident in that. Because we can't guarantee that rates are going to be at 4% in 12 months. We can hope, and I think there's a chance in the next 24 months we might be back there, right? But they have to be comfortable making that house payment now. And so I just advise you to be a little bit careful in how you talk to your clients when they've got a current mortgage with a low interest rate. Because really our job isn't to sell them. on buying a new house or selling their house. Our job is to give them information and guide them on the path if they decide to do it. So just wondering if anybody has had any experience with that, or, oh, Amanda said we're also calling that frozen in place, right? Absolutely. And it's also causing people to be accidental landlords like my clients in Daybreak, right? I don't think they had the intention of buying that house and have it being a rental property, but that's not a bad thing. Having a rental property as part of your long-term investment strategy is fabulous, especially when I run investment property numbers for people right now that want to buy an investment properties. There's not a lot of cash flow because rates are so high. But if you bought a house or refinanced in those golden years, right, and rents have gone up like this, there's a good chance you're going to have some great positive cash flow if you do rent your house. And we do have a lot of people that would do a line of credit on their current house to have a down payment on the next one. So there's definitely ways to look at it and to get a little bit creative. So any other questions on anybody, from anybody, or experiences you've had with clients in that scenario?
I have a question, Bliss.
Yeah.
So one thing I'm seeing a lot of now are people offering more seller finance because they've got such a good interest rate.
Yeah.
So they go, so they do a seller finance. How much of the rent from that can they use? Can they count like towards buying their new property? Have those
Actually an
ratios
amazing
changed?
question that I just got, and I think actually was it Tyson or I don't know, one of us looked into it. That's actually a problem. If you do it as seller financing, mortgage rules state you have to have a proof of 12 months receipt, because that's called notes receivable. So you're better off doing a rental contract, like maybe a lease option to buy, because a rental contract, I can use, so the case of this couple, they're going to rent it for $3,500. I can use 75% of that. So $2,600 to offset their current payment and HOA dues. But if you do a seller financed and you sell that property, I have to prove that you've received that payment for 12 months before I can use it to offset your payment. So it could, unless you have really high income and can afford both on paper, that's going to be a problem.
And how many banks are like, that are holding these mortgages, at the lower rate? Let me just think for 1 second what my question is. How many of them, like say they're doing an assumable loan, how many banks are, making, allowing those loans to be assumed? Like, it's a super hard process.
That's a really
I've never
good
had
question.
anyone do it.
So I will tell you right now, only government loans are assumable. So FHA, VA, and USDA. We have a number of people that are in the middle. So it doesn't actually go through us, but we're kind of staying in touch with everybody we know that's doing it because we want to be able to share that information. Right now, we know of a couple people that are in the process and it's taking months. We also had someone that started the process in like October, and on January 4th, they were told that their servicer would not allow any more assumptions. So even though government loans are assumable, if the servicing company decides to not offer it, they don't. And here's the reason why. They only make about $1,500 or $1,800 on assumptions because they're not allowed to charge fees. But the cost to do an assumption is thousands of dollars. So they're losing money when people want to do assumptions. So why should a servicing company, it doesn't make sense. So I actually think you need to be really, really careful. If you've got a buyer and you look and someone is advertising a listing and it says assumable loan at 2.75%, I would have some really deep conversations. First of all, has the seller talked to their servicer? Do they know the procedure? Do they know how long it will take? Have they verified that their servicer is still doing assumptions? Because even though the government loans are assumable, it does not mean that the servicing company has to honor that. It's crazy. There are some things happening right now where they're trying to make it so they can charge a couple of points. So on a $300,000 loan, if they could charge 2 points, I'd be willing to pay it to get 2.75% as a buyer, right? So then they can make a profit or at least break even. And then I think you would see more assumables happening. But right now it's a scary thing if a buyer thinks that's how they're going to buy a house.
Okay, so with that, and so I gotta think about my question was here again. Assuming your loan. It's only FHA, VA, and USDA
Correct.
loans. And my other question with that, something you brought up.
I had another thought when you mentioned seller financing. The other thing you need to be wary on that, and I personally have bought a house on seller financing and I have sold 2 houses on seller financing. So I've got a little bit of experience with it. You have to make sure that the servicer will allow that wraparound mortgage, because there's a
Yes.
clause in the deed of trust. Because you're basically taking the property out of your name and putting it in your buyer's name, but you still have a mortgage on that property. So you're doing
Yes.
a wraparound mortgage to sell it to that buyer. So you have to make sure that your servicer will allow you to do that. Now, have people done it without talking to their servicers? I was one of them. I did it. Nobody found out. It worked out fine. It was a short-term thing. So I didn't want to raise any red flags, so I did it. But the way that the Utah State Deed of Trust is, the verbiage in there is they could call your loan due and payable
Do.
if you, if you don't do it the right way. So be very careful if you have a listing and a seller's willing to do a owner contract. A seller contract, you need to make sure they get their ducks in a row so that they're not all of a sudden in trouble down the road.
Okay, and I remember my other question. Let's say you've got a property, they bought it for 300, they've got a mortgage of 250, they're selling it for 400. They can assume that, but do they have to bring the additional in cash?
Yeah. Yep.
Okay.
And that's
Just want
the other
to
option,
verify.
right? Yeah, so
Yeah,
you're borrowing
the cash down.
You're borrowing, you're assuming 250,000, but you've got a $150,000 gap. And so most secondary lenders will only go up to 80% for that second loan. So you're still going to be short $80,000. And the interest rate on that gap loan, the secondary loan, is going to be pretty high because it's a high
Pretty
risk.
high. Okay, I just wanted to verify all this, so I've got all the right data. So
Good information.
okay. Yep.
Super. Anybody else have any questions? Tyson, or do you have any comments on any of that? Okay. Well, I appreciate everybody being on the call. We're going to continue to watch interest rates for you. Reach out with any questions. I love, Stephanie, your questions were fantastic. So as real estate agents, you're getting these questions, right? So having the information just makes you look better. It makes you really put yourself in that position of trusted advisor, and we're happy to just kind of back you up in that. So reach out to Tyson or I if you have any questions at all.
Okay, thanks.
Thanks, Bless and Tyson.
Thanks, guys.
Thank you.
Thank you.